Hello and welcome to another episode. We are joined by John again, Big J. How's things, mate? You been good?
Yeah, mate, thank you. Thank you for bringing me on again. Obviously, people like what we're talking about because you keep asking me back. No, mate, things are going well. Things are going well on our side. Look, I think even though we've got the election, so don't forget to vote this weekend for people that haven't already voted. But I think a lot more people are taking a bit more of an objective point of view where they're saying, well, if I'm going to buy a home or if I'm going to buy an investment, this is a long-term play. So, you know, nothing really is going to change material because when you're in property, it's a long-term view. So that's still got a lot of people out there. I think one thing we are seeing is there's still a big gap between the kind of vendor expectations of what they can sell their house for and then buyers' expectation in terms of what they want to pay. So things are certainly staying longer on market. There's a few auctions that are being passed in. So we'll see how that kind of comes out in the wash, I think, post-election, where maybe people have got a time to let the dust settle, rethink about what it is they want, what their ideal prices are, and they can go again.
Yeah, talking on prices, I think a lot of people, buyers from our side, obviously we do a lot of the obviously assisting in lending for purchasing properties. So there's a lot of people getting stuck in that bracket where every average earner seems to fall, especially in New South Wales. You're looking in that sort of 100,000 to $1 million mark. It's still quite competitive, but also, as you say, the sellers, their expectations are, well, market's hot. I want to sell it for 100K above, market or whatever. And the buyers are like, well, they're limited from a lending perspective.
Yeah. Yeah, and actually it might be useful for the people that tune in to talk them through some of the nuances and some of the things they have access to. But you're absolutely right. And look, the median property in Sydney is kind of that $1.5 million, all right, in around there. That's kind of a very broad range, whether you're talking about a home or a unit. Um, but in that price bracket you mentioned, that's 700 to a million, and it is obviously a wide bracket. It's $300,000 difference. But let's look at who you're competing against if you are looking to buy a home or an investment property. You're competing with other first-time home buyers, other first-time investors. You're competing with seasoned investors, people like you and I. We both have property portfolios as part of our wealth creation strategy. Um, you're competing with sometimes with emotional mums and dads that want to help their son or daughter get on the ladder. And so that's something to take into account if you are searching, is you're not the only one with 750, 850, or even $1 million. And so what that does is if you're then going to auction, you're creating competition for yourself. And of course, you can't compete if you're pre-approval. If Ross, you've given them a pre-approval of 850, you can't compete with someone that's got a budget of $1 million or 950 or even 870. So it's okay. How do you work smarter and not harder? And that's where, trying to get as much opportunity, what we refer to as buyers agents, is off market. Individuals can still have access to off market properties. It takes them longer because in essence, what they have to do is build their relationships with the agents that they're in the areas that they're looking in. So if they're buying their first home or their first investment property in Neutral Bay, for example, you've got to go around all the open homes on a Wednesday and Saturday, build the relationship with those agents that are showing the open homes and let them know that you're looking. And so whilst that's a great way of doing it, it's going to take time to do it. But that's a way then to tell them what you're looking for, because then agents can then sometimes give you these opportunities that are off market. But it will take a long time to build those relationships. What I would also say is just because there's an opportunity off market doesn't mean it's a great deal. So going back to what we spoke about at the start, vendors ultimately want the highest possible price. So if they can sell it off market, they still want a premium. So we would always recommend, making sure people do their due diligence, getting an independent valuation, because then that creates less headaches for you when they come to exchange and when the settlement happens. Doing their due diligence as well, and even sometimes letting that property go onto the market so the vendor can get some real feedback on what the expectations are, what the prices are. A lot of questions we sometimes get is, well, why do people sell off market? Typically in that price point, again, that's 700 to a million. If you think the real estate agent's charging 2%, you've got to do styling, you've got to do a full 5-week campaign. The vendor probably just wants to sell it quite quickly. So if they can save maybe 20 grand, 10 grand, 15 grand on all of their costs and still get a fair price, they're happy with that, depending on their outcome as well. And so that's why I think a lot of people, they've got access to it. But remember, the good stuff, whether it's a good market or a bad market, the good stuff sells quick. All right. So where we would typically buy and where you would buy those median price properties, 10 to 15 Ks of the CBD, be that Perth, Sydney, Brisbane, Adelaide, Melbourne, they're always going to go really, really quickly because you've always got the demand. And that median price point where we spoke about, most people can afford to borrow that, as you said.
Yeah, it's cost of opportunity as well. So I talk about this, we talk about this quite a lot, is let's say you're a first home buyer and you're in that $700 to $1 million mark, which is a lot of money. Like it's a lot of money, right? If you're living in Perth, you might be able to get a 3 or 4 bedroom house or a 5 bedroom house for that price bracket. But like, let's talk about Sydney specifically. Yeah, that $700 to $1 million is without a professional by your side is a very difficult market to, the amount of pre-approvals that we do that get renewed 3 times, 4 times, it's ridiculous. And the buyer loses confidence because especially if they're going to auction for the first time and you've got a seasoned veteran buyer's agent there that knows the price point, knows what they're doing, knows how to work the room.
Knows the agent.
You're fighting a losing battle. Also, what we've seen a lot of recently is parents getting involved with liquid cash. And those ones are really difficult as well, because if you go to auction and you've got a parent who is seasoned and they've bought several properties themselves and you're up against a first home buyer doing this for the first time, they're giving their son or daughter or whoever it might be, some probably not as good advice as what a buyer's agent would give, but you're up against competition and you're up against money. So boomers sitting on lots of wedge cash, they might be saying to their sons and daughters like, oh, I'll lend you 200 grand from our whatever, offset account or wherever it might be. I'll lend you that 200 grand. We'll help you. We'll go to auction. We'll get this property. But they're paying overs. They're paying 50 grand, 100 grand over because they're not concerned about getting it for the right price, which is also difficult as well. So it is important.
Yeah, and that creates a few headaches because one, that might create a headache for you doing the loan because when you come to do the valuation piece, in between that exchange and settlement process, the bank might not stack up those numbers. So you may, and correct me if I'm wrong here, from my understanding, you may need to knock on the bank of mum and dad again to get more money. And then the other piece, and we're seeing this quite a lot at the moment, and this has led to this whole vendor buyer price gap, is people that bought in COVID. If you overpaid, and COVID was a hot market, if you overpaid by 50, 100, 200 grand at auction, yes, we've seen growth in Sydney and across most of Australia. But to your point, let's focus on Sydney. If you've seen growth, you're expecting that to be growing on the number that you paid for it. Whereas what's actually happening is because you overpaid, the market was never really at that level.
Yeah.
And so what's happened is, let's say, what was COVID 2019 to 21. So you've had 3 years worth of growth, 3.5, 4 years. But if you've overpaid by 100 grand, you've actually probably only had 2.5 years worth of growth. And they've been slower years because of the interest rate starting to bite. So it's getting people to understand, actually, when you overpay, you can set yourself backwards, from a growth point of view. And you would have heard this expression, or you would know this being in property. You make your money in property when you buy, not when you sell. And so if you overpay from the start, you're always on the back foot.
Yeah, and that's key. So if someone listening is looking to build a small portfolio, 3, 4, 5 properties, but they're just getting that first property is where they're at right now. They're in their 20s, 30s, 40s, 50s, whatever it might be, just come over to the country, or they've just saved up enough for a deposit. Getting that first one wrong at the wrong price point is a big problem for long-term growth, because if you're looking to do debt recycling quickly and you're looking to grow a portfolio, if you get that first one wrong and you can't extract equity from that property to then buy another property, to then buy another property, to then buy another property, you're right. You might be sitting there for 3, 4, 5 years just waiting for it to grow. Or absolutely worst case is you might be sitting on a dud property that you have to sell, and then you've lost your stamp duty fees. You're then going to have to enter the market again and pay stamp duty fees again. So it's one of those things. That first one is so critical to grow a a decent size portfolio if that's what you're looking to achieve. And I think the other thing is as well is that you've got to look at that first one as an investment property. Your first property, especially if you're in that 700 grand to $1 million bracket, is not your forever home. Everybody, I don't know, I'd say 95% of the population wants a 4-bedroom house with a double garage and a swimming pool. And you can't get there with the first one. It's not possible, unless you're just sitting on a trust fund or something. It's not possible, right? So you've got to make sure that you buy it, take the emotion out of it, and you buy it purely for investment purposes, because you're either going to upgrade and sell that property, or you're going to keep that property as an investment property for the future, extract equity and move, and maybe you'll go down the rent vesting strategy, or you'll go down a renovator strategy, or whatever it might be. But yeah, getting that wrong is a big problem, and this is where you'll see, like I think we spoke about this on the last episode, but like areas like Parramatta, if you buy in those high-rise buildings, or you buy studio apartments are killer for trying to get equity out of them, because studio apartments you have to put down a 20% deposit. So that thing's got to grow exponentially for you to then extract equity out of it. Whereas you buy these sort of slightly older red brick easy buildings in the 70s 80s blocks, the larger size, they've got potential to upgrade the bathrooms and add value to them and stuff like that. Those are the perfect ones, really.
Yeah, I mean, a great thing to do is kind of pause when you're thinking about property. There's no hurry. There is an opportunity cost with time, so there is a bit about taking action. But I think if you're going to get into the market, especially if you're a first-time home buyer or first-time investor, have a chat with a broker. And this is where you come in and almost map out the scenarios. We spoke to someone yesterday that they were buying an investment property and their broker had said, do a 20% deposit, but it's an investment property. There's nothing wrong with that, but she has a goal to build a portfolio. And so we were saying, there's nothing wrong with that, but here's another option, because we will buy property ourselves. Have you looked at getting a 10% deposit, but paying LMI and then putting the rest of your cash in your offset account, which brings down your interest rate payments? She wasn't aware of that as an option. And so it's aligning yourself with people that do it themselves, that specialize in what they do, the lending, the buying, the management, even the selling, right? Get the options, get the real information to then say, because the thing is, you don't know what you don't know. And so by working with people that do it themselves, you sometimes get a very different point of view. It doesn't mean it's right, but it's the more information. So speak to a broker like you. What's the maximum that you can borrow? It sounds super uncomfortable, right? $1 million. But that doesn't mean you've got to spend it, but it's getting your maximum scenario, your comfortable scenario, and your easy scenario. What are the repayments going to be? Because it's, and jump in here as well, Ross, but like if you're doing an interest only loan, typically your repayments are cheaper, but you can borrow more. And so what are your repayments going to be? Okay. Then if you're looking as an investment, what does that number buy you across the country? And so when we're talking to investors, as long as you're buying the median style property, so Sydney, the median property is a 1 or a 2 bedroom unit. Most people live in a unit. In Brisbane, it's a 3 or 4 bedroom home. Melbourne, townhouse or villa. Perth, what are some of yours over in Perth? They're freestanding homes. Adelaide, again, it's a townhouse or freestanding home. As long as you're buying the median style property, they're always nice little stepping stones. Think of the Monopoly game to get you to where you want to get to. But don't look at what's for sale for your pre-approval amount. So if you're pre-approved for 700,000, don't look at what's for sale on Domain. Look at what has sold for 700,000 in the areas that you're looking to invest in with the attributes. So if it's Sydney and you want to buy in Neutral Bay, you're probably looking at a 1 bedroom unit with or without parking that has recently sold for that 700,000, or even further out, maybe towards more Lane Cove, Ryde, those kind of areas. That's then getting the real information for you to help make decisions. That's what we would always say. And then if that doesn't float your boat, then you start to look at other areas as well. Again, if it's investment, look at capital growth, capital growth over the last 15, 20 years of each state as well. And then have a chat with a broker to say, well, if you want to be pulling out equity all the time, you might need a place that's really, really smashing it from a growth point of view, like Perth or Brisbane. The last couple of years they've killed it, but they're starting to stabilize now. So you've almost missed your dopamine hit of that massive growth to then pull the money out to then go again.
Yep.
And that's the thing with property, it's always with hindsight. All right. So, I'm sure people would be sitting there, if they could rewind the clock 12, 18 months, you'd buy in Perth or Brisbane. And so it's just working out what your triggers are, but aligning yourself with those people. And then if it's a home, it's the same exercise. If you're pre-approved for $1 million, look at what $1 million buys you in the areas that you want to live in. And then do you want to live in something like that? And if it's a no, then maybe to your point, you change tack and you go, well, let's buy an investment property instead. We're still in the market. We're still going to get some growth. And again, it's not the forever home. So I think if you can try and get the real information from the outset, the whole process should be a lot more enjoyable, right? I mean, you're buying a home, you're building your wealth creation journey, but I would say surround yourself with a team. Most successful entrepreneurs, most successful business people, most successful people in life have a team around them to help them. No one really does it on their own. And I would say it's the same with property as well.
Yeah, that's really key, because also like structure plays a big key role in how you grow your portfolio long term. So we do some clever stuff around trust lending, and it's more, some would say like it's just for sophisticated investors, but it's not necessarily for a sophisticated. Sometimes it's for first home buyers. And essentially what you can do is you can protect your borrowing power long term, which if you don't do it, if you don't get your servicing tested by a broker, you aren't to know whether you're going to cap out on the next property or the next property or the next property. So let's say you had a goal and you were like, I want to make $100,000 passive income. Okay, so we know that we need to map out buying anywhere between 3 and 6 properties. We need to let the market do its thing, and then we might sell down some of the portfolio, or we might just keep all those properties. But we might realize that, okay, if we get to property number 2, you're going to run out of borrowing power here on your current income with your liabilities and what you've got going on and stuff like that. So we might advise, okay, we're going to buy the first one in a personal name. Go and talk to this accountant, speak to them about structuring this correctly. They might advise that you want to buy it in your personal name throughout. And if that's the case, absolutely fine. But they might say, actually, if we're looking to achieve these goals for the second property, we need to put it into a trust. Now, this sounds really complicated, but it's not. So your accountant goes and sets up a trust. You buy the property inside that trust. The debt is now linked to the trust and not the individual, which means that debt is now isolated. So when you go to do your borrowing power again at the bank, that debt is not seen by the bank. Or as long as the accountant can provide a letter saying that trust is profitable, that debt can be ignored for future lending. So it retains your borrowing power. And you can do that 4, 5, 6, 7, 8 times over. But to your point, if you don't speak to the right people up front, you're not going to know these options, like the 10% deposit option. Okay, someone more aggressive might want to buy 2 properties instead of 1 property because their goal is they want their asset value to be X, $2.5 million or whatever. Now they could buy 1 property for 800 grand, or they might be able to buy 2 properties for 600 grand. So instead of their asset value being $800,000, they've now got an asset value of 1.2 million or whatever it might be. So it's really key. One thing I wanted to ask you about, because we're always talking about buying properties, but do you have any hints and tips on selling a property?
Yeah, good question. I always think of it, you're selling one of your biggest assets. And so when we're buying for clients, we want to avoid competition. Okay, so that's why a lot of what we buy is before auction or off market. When you're selling, you want to create competition. You want to create emotion. You want to get people whipped up and in a frenzy. So what we normally say to clients is if you're selling a home, pick a good agent, pay their fee, because they're normally charging a fee for a reason. All right. Get someone that specialises in that area. So in Sydney, if you're selling a property in the Lower North Shore, don't choose an agent that specialises in the eastern suburbs, because typically that agent in the Lower North Shore will have a database of people that have been through his or her homes in the last X amount of years to then pitch that property to. All right. Listen to the agents. If they recommend getting styling, style it. It's a bit like if you was to sell your car, you're not going to sell your car dirty, full of your McDonald's cups and newspapers in the back and all that kind of stuff. You're going to give your car a good wash, good detail, make it look amazing. It's the same with your home. Do a full week campaign, and then ideally take it to auction. Let people get excited and whipped up and in a frenzy about it, because that's what drives the price up. And so we actually have a service called vendor advocacy, which is free for our clients. But what we do is we leverage our relationships with the real estate agents, so again, back to relationships with the agents that we worked with for the last 20 years, to say, Mr. and Mrs. Agent, we've got a client here, Ross, they're looking to sell their property in Lane Cove. What do you think is a realistic price? All right. So don't inflate the price just to get the listing. What do you think is a realistic price? Okay, Ross, this is really what we're going to be doing. And then we actually interview a few agents and we will help manage that process for them. And so it's a nice way, again, of leveraging the relationships to get the truth from the agents, because they obviously want to have those relationships with us and do a good job for our clients as well, or people within our network. But that's typically what we'd recommend, is full campaign, auction, and then the person that puts their hand up wins on the day. Conversely, if you've just bought a home and you need a certain price and someone offers you that quietly, then that's not a bad story as well. So everybody's situation is slightly different, but on the general rule of thumb, it's make the place look amazing and get everyone whipped up and in a frenzy about it.
Yeah, nice. Yeah, good advice. One quick question before we go on to some of the questions that the BSI group have asked. What do you think about this Greens policy? Have you heard about it?
I've tried to switch off as much as I can to the politics side of things. I've recently become a citizen, so I have to vote. So I'll have to really scrub on it for this weekend. But give me the executive summary.
So over 2 investment properties, scrapping all benefits for investors. No negative gearing, all that type of stuff.
Look, I think people, so I can talk to kind of your Brexit and things like that in the UK. So I think what we need to do is stop using buzzwords like negative gearing and actually educate people on what industries that affects, because it's not just a case of a lot of the terms with negative gearing they get associated with very affluent, very rich people. A lot of people across all industries, across all income streams and socio-demographic groups, they are having investment properties as part of their wealth creation side of things. So I think if you're going to be capping stuff, the main problem that we have in Australia is supply. And I don't want to sound like Anthony Albanese here, but it is a supply issue. We are in a country the same size as the USA with a fraction of the population, yet we only live on, a smile of the country, because no one really lives in the Northern Territory on the coastlines. You don't have the same infrastructure. And so it is really a supply issue that I think we have. And so what does that then look like? If you look at the UK, not many first-time home buyers can afford to buy their first home in London, in Chelsea, in Fulham, or in Manchester, in the built-up areas there. You've got to buy further out. And so that's, I think, something to look at from that side, but it is creating supply. So capping it, it's still going to make sure everyone has 2 investment properties if you then do that.
Exactly. It is a supply issue though, and I think there is a if you think about the UK, how dense the UK is in comparison to Australia, if we're going to use that as a comparison. Houses of multiple occupancy wasn't a thing 10 years ago, but now it's the biggest flex in real estate, like investing, right? You buy a property that's a 2-bed house, you turn it into a 5-bedder, the living room gets turned into a bedroom as well. They make them quite fancy, have communal areas for your living space and your garden and your kitchen, and then everyone has their own lockable room, right? We're not quite at that phase yet in Sydney where it's that dense, but it's getting to it. More common than not, people are renting with a friend if they're single, or they're in a house share or whatever. But it's not quite at that level of the UK where it's like common practice to operate houses of multiple occupancy and all these things. Equally, I think there's a difference between Australian attitude and what we might have from back home in regards to commuting. How many people did you know that would commute an hour and a half to go into London just to work, and then commute an hour and a half to go back? But I think there's this expectation that you've got to live where it's happening, which is fine if you're adopting a rent vesting strategy, like we've spoken about before in other episodes. But like say, you might have to go up the coast a little bit. You might have to go down the coast a little bit. You might have to go west a little bit further than you'd like just to get into that first property. You shouldn't necessarily expect that your first one's going to be on the beach in Bondi.
Yeah. And I mean, the challenges with those areas as well is that, as we know, is that, they have height restrictions. So they're limiting the supply, which of course is what causes the price to go up, because when you limit supply and there's a high demand, that's what increases price. And we've seen it in Melbourne. So Melbourne last year hit their new building quota, but and that's great because you've got loads of new buildings, but then their prices have gone down because you haven't got the demand. So it's really weighing it up with how much do you increase supply, because a lot of people's wealth is tied up in their principal place of residence, not just investment portfolios. But if you imagine some of the boomer generation that bought for, in comparison to now, next to nothing, they've got no mortgage and a load of equity, something to consider as well. It's a massive conversation, but I do like the bit around if we can try and increase supply and move people's expectations, like the first time home buyer deposit scheme, I think will help as well from that side. Yeah, it's a different one.
Cool. Also, let's wrap up on a couple of questions from our BSI group. So we've got a couple ones here, actually touching on a couple of things that you just mentioned. Then actually with these guys.
Great, I love politics.
Yeah, well, not politics. So first question, you guys, we took the advice and paid off our home loan, and now we're on to our next chapter. We're looking at getting our first investment property. It's so scary, but we're ready to invest. Any advice, of course, is welcome at looking to get our first investment property. I never imagined that we'd be in our fees and we would own our home outright. Well done. No landlord telling us what to do. We're not renting anymore. It's such a great feeling. We've never had any help or handouts, but thank you for your support so far. Is there any help or advice that you can give?
So they're in their 40s, so it's probably worth looking at, is property their thing? So I would perhaps say have a chat with a financial advisor, and if property is their thing, or if it's topping up their super or buying shares, as part of a share portfolio, look at their options, like get a real firm understanding about what their financial situation is. All right, so it's fantastic. They've paid off their mortgage. That's awesome. And then if property is their thing, okay, well, what is their risk appetite? What are their income levels? Because if they're on high incomes, then they might enjoy buying a property in Sydney, where typically it's a higher price point. You're going to get that growth over the next, say, 10, 20, 25 years, depending on when they want to retire. And then what does that then enable them to do? And if they've then got children, or children come into the mix, is that something they can bring into the family, that kind of thing? But I think, again, it goes back to the point of surrounding yourself with people that can talk you through various scenarios to see which one fits you, because everybody's got a slightly different risk appetite. So that's probably what I would do as a first point of call is, stop and take a breath, maybe acknowledge the win as well. And then go, right, let's have a chat with someone that specializes in this, that can just talk us through our situation. And then say, if property is that, then speak to a broker. So have a chat with you. What's their borrowing capacity? Again, they don't need to spend it, but if they can borrow 1.5 million, if they can borrow 700,000, whatever the number is, okay, then what does that then buy them? Then how does that help them from a cash flow point of view or not? What does that then look like? So it's almost mapping out the scenarios to say, are we going to be better off?
Yeah, correct. We did this with a client the other day, spent an hour on Teams going through their options because they were in their late 40s, $300,000 in savings. They'd just come back from London. So one Aussie citizen, one guy just got his PR, which is great. But the options were like, we've got 10 years, basically 10, 15 years. What do we do with the money? And then it ended up it ended up essentially what they wanted to achieve was they wanted to buy an owner-occupied property with enough land to have a granny flat on the back of it that they could Airbnb for retirement. And that's what their goal was. But every individual case is different. Like with these guys, it's like, well, okay, how, is your superannuation healthy? Are you investing in other things, stocks and shares and the markets and everything else? But also, don't just buy an investment property for the sake of buying an investment property. Like, what's the goal? When you retire, do you want to have one investment property paid off? In which case, you're probably going to have to buy two investment properties. Can you service two investment properties? Because they're in their 40s now. You don't want to be in your 70s still trying to pay off that one investment property that you bought, and it becomes a headache.
Yeah, and we see that quite a lot. Is we get people that have bought a lot of property, so they are asset rich but very, very cash poor.
Yep.
And so what they have to try and do is then sell some of their assets. And this is typically later on in life. So to your point, in their 60s and 70s, they then sell some of those assets, which haven't been performing, to then actually get some liquidity into their world. And that's where, again, it's going back to like with the personal bit, because this young couple in their 40s, they might go, hey, we've actually really sacrificed for the last 20 or 30 years, last 20 years, we've paid off our mortgage. Now we want to go and travel the world. And now we want a career break. Now we want to go to the movies, or now we want to experience things, because they've sacrificed so much. Because there's normally an opportunity cost with whatever decisions you make, right? That's where, again, it's looking at the bigger picture, rather than just that one bit.
Yeah, exactly. Cool. So last question before we wrap things up. Hey guys, I'm a total newbie working on a deposit for a house. I'm looking to buy in the next 6 to 12 months as a family home to live in. Wanting to meet with a broker, as I think this is the first step. Would you utilize the low deposit schemes? Can anyone help with the process? And what things should I take to avoid? I find the process quite overwhelming. Thank you very much. I think I'll take the lead on that one. So
I'm gonna let you drive.
So yeah, look, working on a deposit, that's obviously like the key thing, right? And look, it's a family home to live in. I'm not sure that's going to be the first property that this individual is going to be able to get. Not their dream home, like we've spoken about on the episode already, but definitely utilizing the first home deposit schemes is great. I think it's really handy. You can get into the market, 5% deposit, no lender's mortgage insurance to pay, which is hefty if you don't have it on the scheme. No stamp duty if you're buying a property within the price range, although I wouldn't necessarily, that wouldn't be my be all and end all if you had to contribute a little bit towards stamp duty or a concessional level of stamp duty to get into the right property. Getting into the right property is obviously the key part. But really, first steps, talk to a broker, find out your borrowing power. If you don't have your deposit ready just yet, how much are you saving? When can we map out a time to catch up again and go over, I don't know, maybe you might have another 4 or 5 months of saving to go. Let's have the initial call and we'll find out your borrowing power. We'll map out some scenarios, send it to you in black and white so you can see it, it's in front of you. Then you might want to, if you've got the additional funds, you might want to be introduced to an accountant and a buyer's agent to strategize it a bit more for you. If you don't have the funds, fair enough. You just have to try and negotiate yourself, or maybe you're in a market which isn't necessarily as in demand as somewhere like Sydney or Brisbane, which is pretty hot at the moment, or Perth, and maybe you're somewhere more regional. But look, I think, first steps are essentially find out your borrowing power, map out a couple of scenarios, see which one seems best to you, and then go from there. That's pretty much it. You've got to get that deposit first, but also, is there other options? Can we put you on a parental guarantee scheme? Do your parents, want to secure a portion of their property to basically allow you to enter the market with $0 down, which is something which a lot of people aren't aware of. So essentially what a lot of people can do if their parents have got a healthy asset with a low loan or no loan on it, is they can secure 20% of the 20% deposit against the parents' house. So let's say you're buying $1 million asset just for ease. You can secure $200,000 plus the stamp duty against the parents' property. As long as you can service that whole loan, so 105% of the property value, you can buy it with $0 down. And then in 2 years' time, hopefully that property is at an 80% LVR. You've paid down some of the mortgage, it's gone up in value, and then you can take the parents' security off. It's very easy to do. So there's lots of great options. It's just about getting that that deposit in place and testing your borrowing levels.
I think that's good. Again, it's just gathering information and working out what you can and can't do.
And not rushing like we spoke about earlier, because there's a lot of people that just get their pre-approval, go and buy something immediately, and they haven't actually taken the time to speak to all the right people first. I always say, speak to someone. You don't have to engage with them. You can call a broker for 30 minutes and get the information that you need. You don't have to engage the broker. You can call a buyer's agent and run a scenario, and it'll either be that you guys want to work together or you don't want to work together. Same with an accountant or a financial advisor. You can book in the consultations, talk to individuals, and then you can make your mind out about who you want to use and when you want to use them, etc., etc.
And I think that's hits the nail on the head. But also go with the people that aren't going to charge you for a consultation.
Yeah.
Just have a chat with people, because they're normally the people that can just speak very candidly, very openly, whether they can or can't help you, and you'll work out whether it's a good fit, whether it's you're good for each other. But again, you'll still get information.
Awesome. Let's wrap things up there. Thank you very much, John. Cheers for your time.
No worries.
Catch you on the next one.
See ya.